a concise approach to top-down market strategies and the forces affecting investments. That's the spoken word on investing.
Let's get the spoken word now on cheap oil tailwinds and their effect on stocks with our chief equity strategist, John Blank, joining me via Skype. John, you wrote recently in our Zacks Industry Rank Analysis, cheap oil tailwinds make for great stock prices. How so?
Terry, we really need to go through this, and what it is threefold. First of all, people buy goods with the money they save from the gas pump, and it's no more complicated than going and paying $35 for a fill up over 50. So what do you have? You've got $15 extra, and usually you have it right then and there, and you notice it. So point of sale and proximity, convenience stores that are located on site where a gas station is, are a very good play, and I'll throw a name out there for you. Casey's General Stores, which is based in Des Moines, Iowa. They have about 1,400 or 1,500 of these stores, and this stock is ripping because people are having that windfall from oil, and that's the goods play. Then you've got services, Terry, that expand. People buy more services that are more attractive. So this is your airlines, American, Southwest. And I'll throw a name out that I like in Mexico called Volaris, ticker VLRS. This stock also has the peso play. So then you've got a triple play in airlines. Why they're doing so strong? The consumer is buying more services. The company is paying less for gas. And a lot of these people are finding that the currencies out there are giving them the reason to travel. So airlines, really good play. Third area that I like is the cost players. These are the guys with 30 and 40% of their cost structure dedicated to oil derivatives. They're basically using oil. So the names I'm going to throw out there are Cooper Tire, ticker CTB. This is a tire company in Ohio, but what they have is $7 of regular gasoline going into every tire. So take $1.50 off of a gas price per gallon, you've got $10 cheaper in cost for the same tire. They're making money. The other company I like is Sherwin-Williams, which is these guys. This is paint. So you've got a housing play, you've got a remodeling play. The interest rates are low. Again, a nice play, and they get 30, 40% of their cost from oil derivatives.
So basically the consumer is the beneficiary of these oil prices.
That's correct, Terry. Now here's the trick question and why the market's gone down instead of up in the face of oil. Because what we learn about oil prices, the first thing that happens is prices collapse. And that takes earnings of companies down immediately. I mean, it's a mark-to-market accounting process. So as soon as prices of oil collapse, earnings from energy companies collapse. Now, the economics has always been true, both demand and supply, that it's a much more sluggish and long-term process. So both the supply adjustment, the suppliers cutting back in oil supply, and the demand adjustment, people actually changing their behavior, tends to be very sluggish. So the bottom line is the first half of this year, we are looking at more earnings recession from the oil company values. But in the second half of this year, we're going to see that supply reduction, and we're going to see these demand stocks play on because the economics will play in the second half of this year, Terry.
All right, John, thanks for that. And there you have it in a nutshell. The tailwinds benefiting the consumer from lower oil prices with John Blank. I'm Terry Ruffalo.